You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, welcome back to Infinite Banking Mastery. Over the last 2 episodes, we've covered the scope of long-term care risk and why paying for it without a plan can cost you a lot more than the care itself. Today, we're going to look at what long-term care coverage actually looks like to give you an idea of what's right for your situation. So let's take a look at how long-term care policies work, starting with how benefits are triggered. Most long-term care policies are triggered when you can no longer perform at least 2 out of the 6 activities of daily living. Those are bathing, dressing, eating, transferring, continence, and toileting. However, with all the policies I've seen and worked with, if you were to have a cognitive impairment, such as Alzheimer's or dementia, that is usually a qualifying trigger all by itself. And something I learned recently, according to Alzheimer's Disease International, is that there are over 100 forms of dementia. I did not know that and could not believe it. That is an awful lot. Alzheimer's is the most well-known, but certainly not the only type. Okay, so with long-term care policies, there is usually an elimination period, which is a waiting period before benefits would begin. Most common, I would say, is 90 days, a 90-day waiting period. However, there are other options, like you could choose 180 days or 365 days. The longer the elimination period, the lower the premium. So for example, if you are looking into long-term care and you feel, oh, that's too expensive for me, you could select like a 365-day elimination period that would lower your cost, and then you would be on the hook then just for the first year's benefits. So then you would only have to worry about covering that first year, although you would have to be unable to perform those 2 out of 6 activities of daily living or have a cognitive impairment that whole year, the whole time that you have the elimination period. You would have to be unable to perform those activities of daily living in order for them to see that you are still needing the long-term care benefits. A doctor would need to confirm that. But that is one way to keep costs down and for you to still protect against completely burning through your retirement resources. Okay, so when it comes to choosing your benefit amount, which is the amount you will receive each month once you've triggered benefits to be paid, you will select a monthly or a daily benefit amount. It really depends on the company. They either offer a monthly or daily benefit amount, so it just depends on them. You may want to look into the cost of care in your area to get the idea of the benefit you want to purchase, which is a good starting point. However, the cost of care can easily be more than any policy will even allow you as a starting point. I helped a client a couple of years ago who was highly concerned about the cost of care in her future. She's a doctor, she's still working, and also she was taking care of her parents. Her mom has dementia, and she told me it was costing her a fortune at that time, and that even the top benefit amount of $10,000, that was with the company we were looking at the time, was lower than the cost she needed to care for her mom. So she wanted the highest benefit possible, highest benefit that was offered by anybody, and also an inflation rider, because already today, the cost that she could purchase, if she were to trigger that benefit, say the following year, she did not feel it would be enough. So in Washington State, planning for home care would be at least $7,000 to $8,000 and more if memory care would be needed. Many policies also offer inflation protection, meaning your benefit grows over time to keep pace with rising care costs. Given how fast costs increase, I wouldn't think of not having this rider on my policy. You will have different options to choose from, like you'll have a 3% inflation rider option or a 5%, and depending on the policy, that growth would usually begin the day you start your policy. So that in the future, if or when you need the benefit, it will be higher than the day you started the policy. That's going to be a lot more helpful than it not moving up until your benefits start. Another choice you'll make is the benefit period, which is how long you will receive the benefit once it's paying to you. There will be different options to choose from. For example, you could choose 2 years, 3 years, 4 years, 5. I believe some go to 6 and 7 years. But if you're able to go with lifetime, well, that's really the best option. Now, you may not need the long-term care coverage for so many years, so you don't need to have it be for lifetime. But of course, we just don't know. We don't know how many years you will need it, and you won't know until you get there. We talked about on the last episode how married couples have a 91% chance of at least one spouse needing care, and women statistically need care the longest. That's why I feel the lifetime coverage is the best protection you can have. I feel like if it's affordable to you and it's possible, it's just a great way to go. I had a neighbor who had around-the-clock care at home for 20 years. Thankfully, she had an excellent long-term care plan, the kind of long-term care plan that had options that aren't even sold anymore because it was too costly for the insurance companies to keep such options. So you just don't know. You don't know how long you will need care. So the longer the benefit period, the better. We couldn't believe how many years she needed that care. And of course, each of these choices that you have to make will be a difference in cost. Choosing the option for a lifetime benefit will be more expensive, but maybe not cost prohibitive. We can take a look at what's most important to you and build the best possible policy for you that also fits your budget. Now let's switch gears. I want to talk about the Washington CARES Act. Washington State has this new tax that now taxes every W-2 employee to fund a state long-term care benefit that they call the Washington CARES Act. The maximum lifetime benefit is, drumroll please, $36,000. That's right, $36,000. What even is that? How far do they actually think that will get you? A couple months? I think $36,000 is a ridiculously low benefit, and let me tell you why. I've mentioned before that I serve as a trustee for someone who needs care, and one time she needed around-the-clock care, and in 1 month alone, her care costs exceeded $30,000. So $36,000 as a lifetime maximum, it's laughable to me. It really isn't going to get you very far. Washington State has it listed as a one-time annual benefit and lifetime maximum. Not awesome. Now, they did give a one-time opportunity for residents of Washington State to opt out, but you had to have a policy in place by November 1st of 2021 in order to opt out, and no one has been able to opt out since. If you don't have a policy in place or you didn't have one in place by November 1, 2021, you cannot opt out. When I learned of this in the early spring of 2021, I started shouting it from the rooftops. Hey, everybody, you might want to look into your own coverage, getting your own coverage or acquiring long-term care. The state benefit is super lame, nowhere near enough, and the tax does not have a ceiling. Therefore, you can most certainly expect the tax to go up over time. I was shouting and shouting. I put it all over social media, and no one seemed to hear me. That is until about June, when people started coming out of the woodwork and referring all of their loved ones. It was a super crazy time. Insurance companies started shutting down and not allowing applications after a certain date. I believe Mutual of Omaha was the first one. I believe it was mid-June when they stopped accepting long-term care applications from this state, which was sad because there are people who actually just want long-term care and we're looking at different companies and want to be able to select the best option. And now they just didn't even want to look at people who were looking for coverage and were a good fit and were really just needing the coverage. They just were shutting it down to everybody. And during that time, we were working so hard to get these applications submitted. When you apply for long-term care, most carriers want to see that you've been in for a checkup with blood work within the last 1 to 2 years. So tons of people were trying to get in to see their doctor, schedule blood work, and some absolutely could not make it in. And he could not make it happen with their doctor. So we would get shut down or timed out with one carrier and move on to another. And with each carrier, an advisor has to be appointed. So I was completing appointment paperwork with all sorts of companies to try and help as many people out as I could. And then for those who were able to get their applications submitted in time, then it was a waiting game for the underwriting process, which is usually not a very fast process. A lot of people didn't make the cutoff. And for those that did and got their policy, once they had their policy in hand, they then had to go to a government website to let them know that they had their policy, that they had acquired a policy and they're able to opt out. And they had to get this done by December 31st of 2022. So they had basically a year to get their opt-out completed online with the government site, the Washington CARES Act. And if they didn't do this last step, that was it. They've lost their chance to opt out. I did have clients who we rushed and did what it took to get the policy, but then they didn't remember to do the final step. I sent emails and messages to remind everyone, and yet some still forgot. So they didn't even get to opt out in the end. And now no one can ever opt out again. It doesn't matter if you were underage at the time and now are becoming 18, or you moved to Washington State. Nope, doesn't matter. You have to pay the tax. And if you have this state coverage in Washington, well, it's something. It would be slightly helpful in some way for a short period of time, but I wouldn't mistake it for being true long-term care protection. It is absolutely not a real long-term care plan. In fact, they even require the inability to perform 3 activities of daily living before the benefit will be triggered, rather than 2 that insurance companies require. Yeah, the whole thing, it was a complete mess. And the thing is, other states are currently looking into this as well. The top 2 right now are New York and California. Maryland, Kentucky, and Pennsylvania are also looking into this. I'm not sure if these states will have a cutoff date to acquire personal long-term care coverage like Washington did, or if they will allow you to opt out at all, or if they will have a different opt-out process. But if you're in one of these states, I would start looking into this and learn what they're saying about a possible new long-term care tax in your state. Okay, so next week I will wrap up this series on long-term care. In the meantime, feel free to reach out. You can reach me at Valerie@alphaomegawealth.com as always. I hope you have a fantastic week.
This is the podcastfactory.com.